Well, I'm really, really excited to welcome you here for this topic. We're pleased to have attorney Scott Estill here, former senior trial attorney from the IRS, but then in law practice for over 2 decades on his own with his own law practice. For those of you that are new, this is a webinar series. We welcome, especially anybody that's new. This is a webinar series that's been going on for a very long time. And if you look at that next slide, some of the webinars that we've had so far this year, we really had some really cool people here. Kevin O'Leary, we talked a couple weeks ago, nonprofit corporations and the benefits of those. That was one of the best webinars I think we've had in a very long time. Mike Koval was on talking about the market and how to tell exactly when we're going to hit the bottom of the market. He's saying we're not there yet, but here are the signs. These 3 things, watch for those. When that happens, then we've hit the bottom and it's time to buy. We've had cost segregation. I've talked to you about trusts and which entity to set up, whether it's a C Corp or an S Corp or an LLC, or we've really had some really good webinars. So I encourage you to pay attention to those. All the webinars are recorded, and after it usually takes us about 24 hours, but then they're available on our YouTube channel. So you'd go to youtube.com and Protect Wealth Academy. If you'll sign up for those, you'll get those whenever we post new ones. So I encourage you to do that. For those of you that maybe didn't hear, we chose not to go to the Phoenix Summit. It was scheduled for next Monday, Tuesday, Wednesday. That will not be happening. We could not get enough people in this post-COVID world to sign up for we only had a couple dozen people that actually signed up, and we couldn't justify bringing the whole entourage of attorneys and speakers and everything else. So we apologize if you had to change your travel plans, but I hope you understand. I much rather teach face to face than the Zoom stuff, but it does give us a chance to reach more people without you having to travel. So we appreciate that the next 2 events coming up will be November 14th, 15th, 16th. That's a Monday, Tuesday, Wednesday class. If you can't schedule that, make sure we get to February 6th, 7th, and 8th. The beginning of the year, the end of the year is when we find most entities being created. It seems if you're going to take advantage of the tax code for this year, make sure you get to the November class, but at least one of the 2. So encourage that. And then if you'd like a sample of the agenda, it's always available on our website. So I encourage you to do that. And finally, there should have been a disclaimer slide. Sorry, I didn't do that. So let me add one just in case. We're going to give good principles, how that applies to you, but we can't give specific tax or legal advice. That always run that past a professional. Scott will probably clarify that a little bit, but we can teach correct principles. It's the application. When our students go, this applies to me and this and this and this, and maybe some of them don't. And so we're going to teach correct principles, but run anything you do through a tax professional. And now let's introduce you to Scott. For those of you that have been with us, Scott's been a regular on our 3-day summits and our webinars for over 20 years. We are so grateful to have him, his friendship, and his tremendous tax advice. But I'm really excited about this topic. Up till now, Scott has taught this topic twice, but it's always been reserved for our cruise students. I think we taught this once down in the Bahamas or maybe the Caribbean. And I think, Scott, I think you taught this again when we, similar, we changed all the slides, updated all the numbers, but I think you taught this on our Alaska cruise, if I'm not sure. But either way, it's always been kind of exclusive. This topic takes it for me from this is theory to this is how it applies to me. What we're going to do is we're going to take one property and show you hit almost all the tax topics for real estate investors, depreciation and leverage and ROI, and we're hitting UBIT taxes inside of an IRA. Scott's going to hit all these things. I'm so excited to have you here, Scott. So we're going to turn time over to you. Scott's normal style is to take questions at the end, so write them down. Scott, any comments about how you want to teach this? Is that better for you if I'll hold your questions till the end?
Yeah, I think so, Don. I think that's going to be the best here. I mean, this is a little different than my, the quote unquote the normal presentations that I do, in that, we're going to get really specific with some numbers and just to kind of show you how I go about the real estate tax planning, for a particular property. So, what I can do is, at least on this with some of the Q&A, is I can certainly answer the questions in writing at the end too. Like we do on some of the webinars, if you want to do it that way. Whatever way is best for you, but I'm going to take about 45 minutes, I think, just to go through the slides and get a pretty good understanding as to what we're doing here. So how would you like to work it, Don?
I've gone through your slides. I'm so excited about what you're teaching. I love it. And then you reminder that Scott will be one of our presenters at the upcoming November summit. So I encourage you to plug in for that. But until then, Scott, let's talk about tax strategies for real estate investors.
Absolutely. Thank you, Don. Thank you, everybody, for joining me here tonight. As Don mentioned, I'm going to be one of the speakers at the November online event. I'm going to be talking a lot about the new tax laws, the tax credits for different electric vehicles and what have you. But tonight, totally changing the script, we're going to talk about real estate investors and things that I look for. So any questions that you may have, that you want to shoot them over to me through the Q&A or what have you, please keep them to real estate. So let's not get into stock market questions or small business questions or anything else. Let's stay to the topic here, because there's obviously a lot to cover. And I've covered a lot of these on, as Don mentioned before, on the different webinars through the years. So I probably have done 30 or 40 different webinars over the years. And a lot of them are on the vault that Don has on the protectwealth.com site. But anyways, when I'm looking at the real estate strategies, and I'm going to do some scribbling here on a lot of this stuff here tonight, but with my little red pen. But when we look at a lot of the strategies here, we're looking at strategies on what am I going to do once I sell the property? And so, am I going to try to figure out ways to, get this into a long-term capital gain and then reduce the gain or string it out, or be able to use different strategies that are in place to be able to take advantage of the tax laws in place today. Also, though, we look at some of the issues of when we're operating the property. And I talk about the qualified business income tax deduction. That's that QBI thing that you see on the last bullet point. Talk about those at the 3-day event. But, when we're looking at how can we maximize all of our real estate benefits when we're operating the properties. And what I want to focus on tonight is going to be rental properties, and more specifically, rental properties that are residential as opposed to commercial. The analysis, though, on the depreciation and some of the other topics that, when you start mentioning bonus depreciation and cost segregation, it's like, oh boy, that's not going to be a fun topic. It might be a little boring, a little dry, but we'll try to make it as exciting as possible, because the tax benefits to your overall cash flow And what I mean when the overall cash flows, I'm including your tax bill in that the more that you can reduce your rental income, right, expense out as much as possible, the better off you're going to be from a current tax position. So we want to be looking at a lot of different tax strategies with rental properties. And again, in specific with the residential properties. And I'm going to draw a line here, sort of in the middle of this, right here for the 15 years. So anything up here, okay, so we're talking about property that's 5, 7, or 15 years. You also see some 3-year property and some others, but as long as it's 15 years or less, we can use bonus depreciation on the real estate. And so if you put in, let's say, fence or roads or landscaping, I've seen swimming pool, a bunch of different things that can be 15-year depreciation. Let's say that you put in fencing that costs $10,000 on a rental property. You can take that over 15 years, but we can also decide to expense that in 1 year. And so we have a lot of these choices, I think, that a lot of us that are in real estate rental properties and maybe have 1 or 2 or I have whatever half dozen or whatever the number happens to be. We have a small number of these. We're not sitting on 100 properties and that's basically our full-time income. But this is supplementing our income, maybe to a large degree. But what we're looking at again is right here, 27 and a half years. This is going to be on our residential properties. And we really have a lot of different flexibility here as far as how much we can take. I mean, notice for both last year and this year, our bonus depreciation has no maximum and it's 100%. Now, there are Section 179 that I'm not going to talk about for small businesses, and then also your automobile depreciation, again, for small businesses. By the way, I talk about both of these at the Protect Wealth event. So that's what you see down here at the bottom of your screen. But the bonus depreciation is what really kicks in for real estate. So in my opinion, when we're looking at real estate, we ought to go right into the examples, right? I mean, let's not mess around with, hypotheticals or whatever. Let's go right into something where, I can take a hypothetical and make it a little bit more realistic. So Don mentioned at the beginning a disclaimer. Well, I have this little notice in here just for you to understand that nothing that I talk about here tonight forms an attorney-client relationship. I'm not giving you any advice, legal, tax, investment, accounting, anything, any sort of advice. And whatever you do, always consult your own financial team, okay, whether that's your lawyer, accountant, whatever, before making any investment decisions. So here's what I did for this particular webinar. And that was over the weekend, I decided, well, I don't want to go to something where somebody maybe is promoting something on this where, hey, let me see if I can sell you a rental property tonight on this. No, it's not that at all. So I typed in Denver rental properties because I live in Denver. And the first thing it pulls up is rental properties in Milwaukee. Why? I don't know. So I clicked it. Don't have any idea about this other than on, I believe it was Friday, might have been Saturday when I did this. And so I pulled up this property. Nice little house right here. I don't know anything about the realtor. I don't know anything about the Milwaukee, Wisconsin rental property market, real estate market. I know nothing about it other than I will say that when I lived in Chicago, one of my favorite places to go. I love Milwaukee as a city. So I don't know if this 1,280 square foot place that's going to go for about 130 grand, looking very rental property-ish down here, but nice looking kitchen up here, and what the rent is going to go for here. So I'm going to make a whole lot of assumptions with this particular property. And when I do tax planning, and again, going to be buying this property as a potential rental, so I'm going to be running some numbers here. So I'm in stage 1 here. where I'm going to research the property and decide, do I want to buy this property? And if so, if I decide this looks like a good investment and I'm going to buy it, the question then becomes, who's going to buy it? Am I going to buy it in my name, or am I going to buy it in an IRA or a 401k or some other self-directed retirement plan? So is this going to be in my taxable account over here, which is going to ultimately hit my 1040, or is it going to stay in my IRA, in which case I have completely different tax rules? So number one, who's going to buy it? And then two, how am I going to operate the property? Am I leveraging this on the buy side? Am I buying it for cash? Who's going to operate it? Am I going to have a management company? Am I going to do it? So how am I going to get through stage two, which is obviously for most rental properties, the most time consuming. It's one that maybe stage one and stage three can be just very short periods of time, but stage two could be years or decades. Whereas once we want to get rid of the property, how are we going to do it? Sell it, transfer it, through inheritance, estate planning. What are we going to do? So I've put together 4 different scenarios for this hypothetical rental property in Milwaukee, Wisconsin. Scenarios 1 and 3 are very similar in that we're paying cash for it. Whereas in scenarios 2 and 4, we're going to use a bank or we're going to use some sort of private money lender, but we're going to have leverage. We're going to have a mortgage. And then in scenarios 1 and 2, we're going to do this in a taxable account, okay, which means it's going to eventually end up on your 1040, on your Form 1040 personal return. Or am I going to do this in my IRA or my SEP or a self-directed 401k? All these different possibilities that you can do in a self-directed plan. And at the end of this presentation tonight, we'll have a slide with contact information if you want to talk to somebody in iPlan group that can talk to you about what it means to be able to do real estate transactions in a tax deferred account. And do you want to do that? The question is, do you want to invest in a taxable account or in a tax deferred account? And the tax planning here really becomes just a whole lot of math. And I don't really know any other way to put it. I just closed out a couple of tax planning clients that I had for real estate. And so we finished those off last week or so. And we're doing a lot of the same thing of, do I want to borrow money? And how so? Who borrows it? And under what conditions? But assumption 1, so property in a currently taxable account. So we're going to probably put this into an LLC, let's say ABC LLC, form it in the state of Wisconsin and set it up and take title for this property in the LLC's name. No mortgage, and I'm just assuming a 30% tax rate, a quarter for the IRS and 5% for the state. You may be a lot higher, a lot lower, or whatever. But you're going to see this slide on all of the different scenarios. So I go ahead and I purchase it. I give them full price. Let's say that's what we're going for here. And I back out the land value. Okay, so I'm going to get that typically through the county site. I can have an appraisal done, but somehow I need to know how much is building, in which case it's going to be depreciated, and how much is land, which is never depreciated. So in this case, I find out that about 25 grand is going to be land value. So just a little bit over $100,000 is going to be depreciated over 27 and a half years. So whether I have this in a taxable account or in a tax deferred account, my depreciation is going to be this number. Okay, and I really have no way to get around that. All right. So for purposes, at least of this webinar, maybe there's cost segregation. Maybe there's other ways that I can start expensing some of this number and bringing it down. But for our purposes, we're just going to depreciate the full basis of the amount of the building here. And so then we start looking at our expenses from a cash flow perspective. A couple things. Again, this is all hypothetical. The real estate taxes were on the actual property, so that one I got right. But notice that there's no mortgage interest and no management fees. So if you've got this as an out-of-town property, this number could be 5 to 10% of, what your rent is charging. So we could see an extra, 50 to $100 a month here, maybe a, $500 to $1,000 in the year. So notice we don't have these. I have been told in the past that my insurance claim or premium bills are high. So maybe this is a little bit high, but for our purposes, this is our out-of-pocket expenses on this particular property. So we look at how much money do we have coming in? And again, this assumes that we get 12 months of rent, that we don't have, a month or two where it's sitting vacant, or, we don't get the rent on time, or maybe we're whatever. Some of the problems that every single one of us on this webinar has had if you've owned rental properties in the past. It's not a perfect investment all the time, right? And so I've had a property in Arizona that was sitting vacant for 2 months. First time since 2008 that it was vacant at all. So that's a huge win for me. But again, 2 months of income lost, right? So again, this is hypothetically, we get our 14 grand in, we spend 4 grand going out, and we're looking at a nice little $10,000 cash flow. But we didn't finance this. And so strictly at this rate of return on our cash flow here, we're looking at almost 8%, okay, 7.9%. But here comes some of the problems here. Yes, we have to report this as income on our personal return. So even if we file with an LLC, we're still going to report this on what's called a Schedule E of our personal return. And you can see same numbers, rental income and cash flow expenses. I also get the depreciation. So what that means is that I'm not going to be taxed on the full cash flow. I'm going to be taxed less the depreciation. But nevertheless, even at 30%, I'm still paying almost 2 grand in tax. And so what that does is it takes our cash flow from this 10 grand and really drops it down to 8 grand, because I've got to pay Uncle Sam, right? And I've got to pay maybe the state of Wisconsin, or, in my situation, the state of Arizona for that property, or my Colorado rentals or whatever. But however you want to look at it, by paying almost 2 grand in tax, we've now taken our rate of return from almost 8% down to 6.4. And the only difference here is that we've got taxes to pay. So, that's scenario number one, where we're investing in our own name with no mortgage. All right, let's look at scenario number two, no more write-ons as far as this little cartoon is concerned. So here we go, same property, everything is still the same, except for we're getting a 75%, this LTV is loan to value, meaning that I'm going to borrow 75% and I'm going to put down 25%. Same tax rate. Okay, so nothing is changing there. So what's our difference here? Well, we still have the same depreciation, same rental income. So this slide is the second time you're going to see it out of 4. So get used to it. Nothing's changed here, but the amount invested has changed. Now, a couple of comments on this. One, you may have to put down more than 25%, or with closing costs, it may go higher than that. And the other thing is that, yes, we're going to get a fixed rate, but are you going to get it at 7%, or is it going to be 7.5%, or 8%, or 10%, or 14%, or 6%, or 5%? I don't know. My crystal ball right now is really, really foggy when it comes to interest rates. Okay, I think we're going to see this rate go up, and I think the 7% is going to be a little optimistic now, but I don't think it's going to go up a lot more before it plateaus. But anyway, so just consider my assumptions here that you may not like my 7% rate, and you may say that you're going to put down more than this. But for our hypothetical situation, what we're doing here is going back to this previous slide here, excuse me, went the wrong way. Going to this previous slide, having this 648 per month and multiplying it by 12. Now, I realize that not all of that is a tax deduction because some of it is going to be principal. So your interest deduction is going to be a little less than this, but it's still a cash flow issue. And so these numbers are all the same as the prior slides. Okay, the only thing we're doing is going from 4 grand to 11 grand with the mortgage. And so that's where our big difference comes. Now, if we look at this as far as the cash flow goes, notice that our rental income's the same, but our expenses are a lot more, huge more, right? As far as, the fact that we're going from 4 grand to 11 grand. So our cash flow is greatly reduced because our income staying the same, but expenses going up. But our amount invested here is only 25% of scenario 1. In other words, the bank has taken on a lot more of the risk. And so even though our cash flow is way less, our amount invested is considerably less, and our rate of return is really similar, right? We had 7.9% in the first one, 7.8% in this one. So I can say, if we round off, that both of them are 8%, and it's kind of negligible as far as, really what's the difference between the two. And there really isn't as far as the cash flow goes with the investments and the rate of return. Here's where the difference comes into play, right? And the difference here is that with this particular property, we get the depreciation deduction. So yes, we have the same income. We know our expenses are up because of the mortgage interest, but we also get this depreciation, which is not out of pocket. So our cash flow here is positive, not a lot, but obviously the difference between these two numbers is going to be our cash flow being positive, this 2,540 number. So a little bit, but then again, better than nothing. But we go to here, the depreciation comes off of our taxes. So instead of paying taxes here on our profits like we did in scenario number 1, we're actually getting a loss on this property. And so the loss, even though it's relatively small, is actually going to save us money in tax. And this is the real big part here. The tax savings are going to increase our rate of return. So even though nothing changed here except for a mortgage, the fact that we now get this little tax benefit here with our rental property goes to our rate of return and the amount invested. And so now instead of getting a little bit under 8%, we're getting now 9%. And again, just like example 1 or scenario 1, where the only difference between the rate of return before and after was taxes, the same thing here is the case, that if you want to jump up the rate of return, let's make sure we focus on a tax benefit. And let's make sure we can get this $372 or whatever it is back on our taxes. And that part, I think, is really the huge part of this. And, if you don't do the tax plan, you don't understand necessarily the differences. And I'm going to have a chart on all 4 of these so you can see just what the differences are here between leverage and no leverage, taxes and no taxes, and being able to get tax benefits or not. All right. All right, next one here that I want to look at, scenario number 3. Let's get ourselves into an IRA. And, a question I get a lot of times when I was doing sort of introductory type real estate tax planning classes is, well, can we even put real estate in an IRA? And if you talk to Fidelity or, Vanguard or TD Ameritrade or one of those, they're going to say no. And they're going to be right. If the question was, can we do real estate in our IRA and have you manage it, have you be the custodian, because they don't do that. But there's lots of groups that do. And I mentioned iPlan Group. Again, I'll have their contact information at the end if you want to get a consult with them. But there's no reason why you can't do this in an IRA. Or when I say IRA here, it can be any other tax deferred account. So this IRA could be in a 401k, it could be in a SEP, could be in a simple, it could be in some plan that you're self-directing. In other words, you're not investing in your traditional type investments, your stocks and bonds and mutual funds and money markets and that sort of stuff. So scenario 3 says we're going to go into this tax deferred account and it's not leveraged, okay, meaning no mortgage, meaning I'm paying for it in cash, just like scenario number 1. I'm not going to borrow anything, same income tax rate. I'm going to skip over this next slide because you're totally sick of seeing it, right? Same numbers here. Nothing has changed as far as our depreciation goes. And this slide is exactly the same as scenario number 1. Notice nothing has changed here. Our cash flow hasn't changed in any way. I mean, the only difference between scenario 1 and scenario 3 is that one's in a taxable account and number 3 is in a self-directed account. They both can be owned by an LLC. And just in this case here, the LLC's owner or owners, I guess, if you wanted to have two IRAs, would be the IRA. It wouldn't be the person. Whereas in scenario 1, the LLC would be owned by one or more people and it would be taxed on the 1040. So again, scenario 3 looks exactly the same. Don't have to worry about mortgage interest. And again, management fees is the only common one that I have a 0 on here. So again, same 7.9% return. So it makes no difference, at least initially, whether you do this in an IRA or otherwise, right? You're going to still get the same rate of return. I think the difference, though, is going to be on this slide. We're still going to get the depreciation. So if we look at, again, these same particular numbers as we had in scenario number 1, I pull in 14 grand, I back out my 4,000 of cash flow expenses and my $3,800 of depreciation. And I come up with this $6,000 of taxable income. Well, take a look at what happens here. In an IRA, we don't pay any tax on this. And so instead of paying almost $2,000 in tax, we're going to pay 0 here. We pay nothing. And so if you take a look at this, the tax bill here with being 0 means that our after-tax rate is the same as before taxes. And so without this mortgage, we are going to get a better rate of return if we do this particular transaction in the IRA than if we do it outside of the IRA. Okay, that all may be well and good while we're operating the property. One thing I want you to think about, though, and this is before I'm going to get into scenario 4, is that there's 3 stages of the game. Should we buy this property, right? This is our North 41st Street property. Should we even buy it? Then what is it looking like when we operate it, when we own it? And that's what this stuff is getting into. But our third one, and we should look at this up front, is what are the potential tax implications if we sell it? Now, it doesn't mean we're going to sell it, but it would be really helpful to know that if we sell this inside of our IRA or outside of our IRA, is there a difference? And the answer, as you would probably suspect, is yes, there is. All right, moving away now from that particular cartoon to scenario number 4. Same exact issue. Property is leveraged. Mortgage at 75% loan to value, so my mortgage is the same. Notice this box, and this is something that Again, I've talked about when we're doing self-directed IRAs, and I know that the Protect Wealth, if you go to the protectwealth.com down here, there are different webinars I've done on self-directed IRAs and non-recourse loan, meaning that if a lender lends property or lends, excuse me, funds to the transaction, it has to be against the property. They can't go after you if you don't pay on the loan. And so obviously this is going to be a much more risky loan for the lender. And a lot of times the 75%, they may want that to be a lot lower, right? They may want that to be 60 or 70% instead, and making you put more down. But anyways, we're going to keep this scenario the same here. But again, non-recourse loan. Otherwise, we've got a prohibited transaction and we have a disqualified event. A lot of bad things happen. But anyway, here we go. So it's the fourth time you've seen this slide. It's all the same as far as the depreciation goes. One question I do get, though, is who cares? Who cares about the depreciation when it's in an IRA? Because we don't have to pay tax. That's not necessarily true. And so we do care about the depreciation, because when we finance a property in an IRA, okay, or in this case, we do a 25% financing. Notice this is the same exact slide that we had when we were financing it in a taxable account. But the difference here is that the financing now makes some of the transaction potentially taxable. And this is where we sometimes drop the ball, I think, where we stop and we think, this is in an IRA, it's not taxable. I don't ever have to worry about tax until I pull it out. And if it's a Roth, I never have to worry about tax. And that's not the case, because when you use financing, when you use leverage inside of your IRA, you do have a potential tax hit. And that's this UBIT tax, this UBIT. And again, that's something that you need to be aware of before you self-direct anything in a retirement account. You need to just get familiar with the prohibited transactions and what sort of disqualified persons are out there, so that you don't do anything that's going to disqualify your IRA. Also, you need to be aware of what sort of issues can generate a tax bill. And one of them is financing property within there. So again, we need to pay attention to the expenses. So this isn't something where we can say, like scenario 3, if I go back and say, well, there was no financing here, so it doesn't matter what my cash flow is, it's all going to be tax-free. Well, here we could have a potential tax bill. So it makes a big difference. We need to make sure that we keep good records, that we can for sure point out that we had $11,860 of expenses. But again, we look at our cash flow here. And again, you can see this is the real small cash flow because we don't have a lot of money put in, right? We're only putting in 25%. Now, again, the reality, you might have to go to 30 or 35%, and this number is going to be higher. But if that's the case, your expenses are going to be lower because you're going to pay less in mortgage interest. So your rate of return is going to be relatively close to this. It's going to be similar to this 7.8%, which again is what we saw on the one where we leveraged it in a taxable account. But here's where I think the big difference comes in. We have this loss, but we need to make sure that we capture that loss. We don't have to worry about a tax bill here because we with the financing and everything else, even with our percentages of 75% financing here, we still don't have to worry about paying any of this UBIT. But this is unrelated business income tax. And sometimes you see it as UBTI, which would be unrelated business taxable income. So, kind of doesn't really matter what you want to call it. Just be aware that if you're doing financing in your IRA, you have a potential for a tax bill. I should say your IRA has this potential, and you need to be aware of it because it can make a huge difference. Now, in this particular case, our rate of return is going to be the same because we don't have to deal with any tax benefits or detriments, right? We don't owe any tax on this. We don't get anything back as a result of it. And, that's not that big of a deal, I think. Just realize, though, that with the leverage here, that our rate of return, we're not getting the full tax benefit of the mortgage interest that we would be getting under scenario number 2. And here's kind of the way to look at it. And I think these numbers are kind of weird when you look at it. And again, I knew nothing about this property before, and for all I know, this property's sold and whatever. But the numbers in this column surprised me. I would have expected there to be a much bigger variation on some of the cash flow numbers, and there really isn't. Because the before tax numbers take into consideration mortgage interest here on 2 and 4, but also the higher expenses, but also the lower amounts invested. And so, really, it's not going to make any difference before tax which way you go. But here, we don't have mortgage interest in scenario 1. So we're going to pay tax that we don't have to pay in this scenario because we're going to actually get the benefit of a loss. Where here, what we get is basically just zero out the income, but we're not going to get the loss. So if we just look at the operation of this, it looks to be like, if you want to look at the risk issues and disregard those, risk meaning that if we have leverage here and we have a problem with the mortgage, we could have a foreclosure and all the associated issues with that, not only financially, but credit wise and everything else. But I think if we're looking at the numbers here, certainly leveraging property in a taxable account is going to produce, in this particular example, the highest after-tax rate. And then doing it in an IRA would be, with or without leverage. And then the last one would be to buy cash or pay cash for the entire property. Now, this is 2 of the 3 sort of stages. We have to look at stage number 4. Now, before I do that, I'll let you go ahead and read this letter so I can get a quick drink here and make sure you read the quick PS. Anybody want to volunteer? I know Don Pendleton's usually pretty good about this. You want to sign this one, Don Pendleton, taxpayer, and give your social security number, Don. Let me know how that one plays out. But anyways,
nice try, Scott.
Yeah, I don't think I'm gonna try to squeeze Don's social out for the next one and send that in myself. But
I like your Snoopy letter better, Scott.
There you go. But let's just hypothetically look at. So I bought this Milwaukee property yesterday, closed on it and everything, and I'm going to sell it in 4 years. Now what happens? Well, let's just take these assumptions just real quick here. I bought it again for this 130 grand. I'm going to hold it for 4 years. And in those 4 years, it's going to go up 5% a year. And I'm going to compound that annually. I'm going to depreciate this property. So we already know that $3,700 number times 4. So I get this $15,000 of depreciation. And when I bump up the 130 over this period of time, I'm going to sell it for 157.5, which is a little bit less than that 5% appreciation. So here's just some really rough numbers. And I know this is a really ugly slide because there's so many numbers and it's all over the place, but it's really not a difficult slide to understand. And I just want to walk you through it because this looks like a whole lot of tax garbage here. but we can just plug these numbers in and figure out what is really going to be our benefit and which way do we want to go on this. So on this one, this is our hypothetical sales price. Remember, I just bought this property yesterday, right? So I just closed on it. So I have no idea what it's going to go for. But let's just assume that this is the case. And I know that I bought it for this amount. And when I sell it, I'm just booking in a 6% closing costs, commissions, closing costs, whatever. You can obviously change that percentage however you want. So I'm figuring here, I'm going to walk away with this amount. All right. And that is a really nice 18 grand at the closing. I'm going to pay tax though on the depreciation recapture, which is a 25% tax. This is not negotiable. Okay. So there's no way to really reduce that. One question I get is, well, what about if I just don't claim depreciation? Then I don't have to recapture it. And that is not true. The problem with depreciation recapture is that you have to recapture any depreciation that, and here's the kicker, that you claimed or was claimable. So if you don't claim it, but you could have, which you certainly could have, and you should have, they're going to get taxed on it anyways. So in this case, so we get this little depreciation recapture tax here. We're going to pay capital gains up here, right? On that 20, and I'm using a 20% rate for that. And so here's our capital gains rates. And so we're going to pay tax on the total amount of 7409. And so what I've done is I've taken our 18,000 that we had at the closing and I've subtracted our taxes. And so now I get how much we're really going to walk away from the closing with. Then I look at our rental income because I've got 4 years of rental income. In this particular scenario, I was going to get like 10 grand of income, right? A year. So I've got this 41,000 of income. And so if we take a look just real quickly at this 52,000 that I'm going to get, and that's the amount after tax plus my rental income, I can see that when I put in this 129.9, I'm going to get about a 10% rate of return each year, or about a 40% total rate of return. And so now I know that, and again, you could say, well, maybe there were some taxes here, or that there were some income taxes. You've got to bring this number down, but then this goes up. You can see the parameters could so easily change no matter how you want to attack my assumptions. And I think that's fine as long as you're making some assumptions. So I'm taking this and I'm looking at this going, if this goes up about 5% a year for the next 4 years and I sell it, when I book that with all my rental income and what have you, I'm going to walk away with about 10% a year. Is that good or bad? Well, I don't know. Let me see what happens if I leverage it. So again, still plugging in these same numbers, our sales price that we're going to sell it for, what we bought it, same commission, same depreciation recapture and tax, same capital gains, right? Everything is still the same here, 7409. And I go back to this slide. Oh my gosh, that's ugly. But here's our 7409 right there. Okay, so our 7409 hasn't changed at all. So we're still getting this cash return, but the rental income has changed. And so when we look at that, our net rental income plus our cash return, our total return here is so much better than the first one because the bank took some of the risk for us, right? The leverage here. So instead of getting 10% here, I'm getting a little over 16. And instead of getting 40% here, I'm getting a little bit over 60, a little bit over 64%. And the only difference here is the amount invested, right? My return's going way down because I'm paying all this mortgage, the expense, interest, principal, whatever, but my amount invested is way lower. And so in this particular case, this is a better situation if fully run the numbers than doing it in scenario one. Now, I may decide to do it in scenario one that way because I don't want a mortgage. I don't want the risk of having a eviction, sort of a mortgage foreclosure type of situation. But these are what the numbers say. Now we can do the same analysis in an IRA. No mortgage. So again, these numbers all look the same, but look at the tax bill here. We don't have to worry about a depreciation recapture. We don't have to worry about capital gains taxes. And so even though our net rental income here, still pretty similar to the first one, our actual cash at sale is going to be considerably greater because I don't have to worry about capital gains or depreciation recapture. And so instead of earning a 10% rate of return, because I don't have to pay taxes, my annual rate goes up, right? It goes up more than 10%, right? Instead of 10%, I'm at 11.4. And instead of at 40%, I'm at almost 46% because my total return is higher because my tax bill is lower. So if we're looking at the differences between 1 and 3, and the only difference there is the IRA, then doing this in the IRA certainly looks like a pretty nice deal. Again, you've got to run the numbers. And here's our final one, our final number of the evening. And again, these numbers all look the same, but here's the difference. And this is kind of where the numbers get a little funky as far as the calculations, is that I've got to figure out how much of this stuff was due to leverage. So in this case, 75% of my capital gain was due to leverage because I have a 75% loan. So I'm going to pay taxes on 75% of my capital gain. And I'm going to pay taxes on 75% of my depreciation recapture. So my tax bill isn't quite as high as it would be otherwise. And so take a look at the difference here. Again, with the cash here plus our net rental income, notice though that the amount returned relative to the amount invested is considerably higher. And that's because of we did not have to pay a full 100% of the tax on these numbers. Okay, so instead of paying that 20% and 25% on the full amount, I'm only paying it on 75% of the amount. And so I'm getting this tax benefit. So what does this all mean? Well, I know it's a lot of math, way too much math for a simple brain like mine. But when we put this together and we do like some really formalized tax planning, we can look at our hypothetical investments after the sale of the rental property. Because before the sale, these numbers were pretty close. If you remember that between the 4 scenarios in this column 1, they were all right around 8%, 7.8, 7.9. And then when you started looking at the annual return after taxes, that's when you saw a big difference. So by looking at just these numbers, we can see that leverage is going to produce the highest potential returns. And whether we do that in our name, in a taxable account here, or whether we want to bump up the return a little bit, and by doing it here in a tax deferred account, you can see this is where the biggest bang for the buck is. And if we decide that we're not going to leverage it, in other words, we're going to use a full cash investment, well, our spread gets a little bit smaller. But again, it still beats out by 5%, 6% or so, doing it in our own name. So, what does this tell me here? I mean, beside the fact that this stuff is all very complicated, what it tells me is that before you buy the property, you need to run some sort of an analysis to figure out who's going to own it. Now, you may already know that I'm definitely doing this in my name. I've got a couple $100K over here that I want to put into real estate. I don't have that kind of money in my IRA. So forget the IRA. It's like, okay, that's fine. So then we know right away that 2 is out and I can X out 4 as well, because we know you're not going to do it in a tax deferred account. But if you've got the flexibility to look at all four of these numbers, why not look at them? And again, if you know you're not doing it in those, then you only have to look at 1 and 3. But whatever you do, you need to do some planning with it, because without the planning, you're going to end up with just a miserable tax result here. And so, I think, Albert here is right. The hardest thing in the world to understand is the income tax, but we've got enough things to work with, at least as far as the real estate strategies go, that no matter what we want to do, taxable or tax deferred. And can you imagine using the Roth account for some of this stuff where it just can keep growing over and over and over again? Amazing. So if this is something that, that interests you, I told you that I would put iPlan Group's contact information up here. So if you want to go talk to Jill or one of her consultants so that you can get some sort of, strategy or structure in place for yourself, highly recommend it, just so that you understand all of your options. You don't have to do it, right? Just like, you can look at, 20 different rental properties. You don't have to buy them all, or you don't have to buy any of them. But if you do decide to do it, just understand what your options are, no matter which way you want to structure it. And I think Jill's group can certainly help you out with that. So with that, I see Don has popped back into my screen here, and I'm going to turn it back over to you. I know I went a little bit longer than what my intended 45 minutes was, but I think it's an important topic, because when people, I don't know about you, Don, but when you bought your first rental property, or I know when I did, I was excited about it. It's like, this is really cool. I finally have a rental property. I'm finally going to make some passive income. I'm going to provide a nice home for somebody to live in. But I didn't really think about like all the tax consequences, initially. I mean, before I closed, I did, being a tax nerd like I am, but we really need to do this as real estate investors. I mean, we really do need to consider it, because I mean, it can be, like 30%, right, of our profits go to this partner, Uncle Sam, who we may not want to be in partnership with. So we have to consider it. And I strongly encourage everybody to, have that tax plan in place before you start jumping into some of these transactions.
Yeah, not only did I not consider it, I had no idea about taxes. The first house that I flipped, I think we made $35,000. We flipped a house in like 6 weeks. It was right across the street in our cul-de-sac. I was doing my own taxes. This was 30 years ago. I had no idea there were capital gains taxes attached to that. Like, is there a statute of limitations on that 30 years? I don't.
Yeah,
unreported income. Probably not. I don't know.
It's silly. It's all silly, as far as trying to understand the tax laws. But I think just the basics, right? That whenever I buy a property, whenever I sell it, and then of course when I'm operating it, all three of those have tax ramifications. And if you don't have a plan in place for all three of them, you're going to miss the boat. Like here, maybe it would be better for you to do this in an IRA, but if you don't structure it that way at the beginning, what are you going to do? Try to transfer it in down the road? I mean, good luck with that one. It's going to be a prohibited transaction. So, understand your options up front so that you don't get tied down with some options you don't really like on the back end.
Now, let me comment about Jill. It's a small IRA company, probably less than 10 or 15 employees. And Jill is an incredible investor. And she does most of these consults herself, even though she's the president, CEO of the company. If you sign up, go to protectwealth.com/iPlan, you get a consultation with her or somebody on our staff, but generally with her, and tell her what you're doing. And she'll tell you, she knows the lines better than anybody that I know, what you can do and how to do it. And she's a pretty sophisticated investor. Okay, so let's take some of these questions we have. If you have questions, go ahead and type them in, real estate related. Okay, so Mark, when you sell the property, there's depreciation recapture. Okay. Is the total amount of depreciated amount recaptured, or how is the time frame that only a portion is depreciated? How does recapture depreciation? I know that scares a lot of people. I don't want to do bonus depreciation. I don't want to do cost seg because then I'm just going to have to make it up on the back end when I resell the property. I'm going to have to recapture the whole thing. Scott, explain that. How does that work?
Yeah, and this is like a really good question, I think, as far as that the recapture goes back as far as you've owned the property. So it's not like a 3-year period or, other little statute of limitations. So it's the entire time. But you want to do it. I mean, you're looking at getting the deduction today. So what we're doing is we're reducing our tax bill today with the understanding that in the future, we may have to sell this property and recapture some of the depreciation at the time we sell it. And so we're saying, let's defer the tax to the future because we don't know what that's going to be. And let's get the benefit up front with the depreciation that we're going to claim. The other thing is that there's ways on the back end that you can, let's say you do a 1031 exchange, you don't have to recapture the depreciation then. And if you have an estate situation where, let's say I own a rental property and it's got 20 grand of depreciation and then I die, and let's say Don inherits my property, Don doesn't have to recapture that depreciation. So there's lots of things that can happen in the future, or maybe the Congress 10 years from now says, for this 1 year, you don't have to recapture depreciation. I mean, there's all kinds of weird things that happen with the tax laws. So let's get the benefits today and we'll deal with the problems in the future, especially since if we don't claim the depreciation, we can still get taxed on it.
Great, thank you. Charitable remainder trust is also another way to avoid the recaptured depreciation. There's ways to do that.
Yes.
I agree with you. I think I would take the depreciation now, and if I can get it. Okay, William, I understand that you make more than 150,000, that you can't recognize the loss when you sell the property.
Excellent question, William. That is maybe true. How do you say that as far as the taxes go? So for the average person, if you make more than 150K, that is absolutely true. So you don't want to be the average person, right? Like I'm the average person, unfortunately, so I can't deduct it. What you want to do is qualify as a real estate professional. And by qualifying as a real estate pro, then you could make 150 million and still get to recognize the loss. And that's the whole, do I work at real estate more than 750 hours per year? And, okay, it's a big and, is my time spent on real estate more than any other business? Okay, so if I spend 1,000 hours a year practicing law, I have to spend at least 1,001 hours a year in real estate. And so a lot of people don't meet that. But if you do, the 150,000 cap is eliminated.
Okay. I'm not sure what FJ is referring to.
Well, it looks like we've got 51. Boss. The next one, will Scott make any comments on the new hires? Yeah, I can. I mean, that's an interesting one because there's billions and billions of dollars in the Inflation Reduction Act that was just passed, about a month or so ago, and billions of these dollars go to the IRS, and the IRS has said that they're going to be replacing about 50,000 employees that are going to be leaving in the next 5 years, anyways. And so the question then is how many more people are they going to hire than the 50,000? We don't really know how many that's going to be. I mean, I saw 80-some thousand, but that's if all the money went to employees, and it's not. But, IRS is hiring. So if you know anyone looking for a job, I don't know.
There we go. Related question. I'm trying to find out if I don't have a tenant in my investment for 6 months to a year, is the amount that I would have received if the tenant had been there deductible? If not, why not?
Okay, so that's a question I get a lot as well. So my example, 1,400, or what was it, 14,400 a year. Let's say my property in Milwaukee sits vacant the whole year. I cannot deduct that as a loss. And the reason for that is because I'm what's considered to be cash basis, meaning that I don't report the income until it's received, and I don't report the expense until it's expensed out. If I was accrual basis, that would mean that I would report the rental income whether I got it or not. And then when I didn't get it, I would get to deduct it. And so zero it out. It's something that's hard to understand, but it's just if you don't get the money, you don't get a loss for it, because I've not seen any accrual basis taxpayers doing real estate. We're all cash basis. So no, you don't get it.
Could you take it? Could you accrual basis? I know you can with a business. You have cash. You get to select whether you're tax or accrual. I've never seen real estate
There-
investors do
yeah,
that. Is
yeah,
it possible?
it's possible, but there wouldn't really be much of a reason to do it, because I mean, sometimes with the accrual stuff, it has to do with, I mean, usually it's a timing issue. When are you going to recognize income? When are you going to recognize expenses? And is there a way that, that can be manipulated to in a legal way, to be able to increase, my tax efficiency, let's say,
Sure.
reduce my tax bill. But with real estate, again, you'd have to report the 14,400 as income. And then when you didn't receive it, you would get to deduct it. So it would just wash out. And I don't see a timing issue, considering real estate, at least for most of us, is going to be on a fiscal calendar year. So a timing issue, I don't really see it being a big deal here.
And it would really complicate your taxes on that, wouldn't it?
Yeah,
Or your
absolutely.
accounting, at least, yeah.
Yeah,
Okay.
and again, I mean, you can complicate things all you want,
Okay, got
but
it.
but if you're not going to get anything out of it, I don't like doing that.
Okay. William is asking why you didn't use in your example a Roth IRA. Why was that?
Yeah, and I absolutely could have there. The Roth IRA, the difference between your Roth and a traditional is just when is the tax paid. So a Roth IRA, the tax is paid today, and then you make the contribution, and then everything is tax free. I strongly advocate Roth IRAs. I mean, almost any calculation you do until you get really close to retirement age, but you're in your 20s, you're in your 30s, you're in your 40s, 50s, whatever, Roth IRAs almost always come out better, because it's almost always better to pay the tax up front and then get the tax free, not tax deferred investing. So all of this stuff that I'm talking about can be done in a Roth or a traditional IRA. And your results, I mean, the cash flow is going to be identical. The difference is going to be the taxation.
Okay, good. So, yeah, could have, but we didn't. Okay. Does it make a difference in the numbers if the husband and wife are both on W-2? They're both W-2 employees?
No, I don't think so. I think, that
Yeah, probably not.
no, it might be a little bit better. I mean, if you've got a husband and wife rather than a single person, you would have a little bit easier time of deducting the rental property losses. And then also
Because we
remember,
were only looking at that one transaction, not looking at your whole tax picture.
right, there could be a whole lot of other things on the return, but remember also, though, that if one spouse qualifies as a real estate pro, both of them do if they file jointly. So, if I'm making $100 million a year and my wife qualifies as a real estate pro, which we can deduct any of the losses, even though our income is way, way over 150 grand.
Okay, great. Thank you. Okay, I have a question. My father just paid off his mortgage. The value is about 400,000, and it's been rented for almost 2 years. He wants to find a deal going forward into going into debt again. He's interested in investing, but he has always done retail property purchases, not willing to do another 30-year or even a 15-year mortgage. Any suggestions? Well, you pick the number almost, couldn't you? You could do a 5-year or a 10-year, depending on the mortgage broker you're working with. You pick
Yeah,
out the option.
don't you think, Don, on something like that? I mean, if you work with somebody that's familiar with commercial and residential properties, in other words, not homes that you're going to be occupying, I mean, there's all kinds of different fixed rates. There's ARMs. There's like 1.5, 1.3s. There's all these different types of mortgage products that would probably fit what he wants to do. And you can have a 5-year balloon payment type note. I mean, there's private lending that you can do through something like iPlan Group or whatever. So again, look at all the different possibilities here, because there's almost certainly something that's going to work right.
Yeah, and I understand having a paid off mortgage is a wonderful thing, helps you sleep at night, but it causes two problems. On the asset protection side, it makes it vulnerable to lawsuits. If it's highly leveraged, you've got nothing to lose. If it's fully paid off, you've got a lot to lose. Okay, so that's one problem. And the other is you've got a lot more at risk, which means your ROI is almost always going to be lower. Now, there's a trade-off, and I'm not suggesting everyone go into debt. Some properties, like my home, I like to have it paid off. But the ROI in investment properties is almost always going to be greater with debt. Scott, what's your take on this? You've seen hundreds of investors come through with their taxes.
Yeah, I don't think there's any doubt. I mean, having debt on the property is always going to produce a better cash result, or tax result, than going with an all cash investment. I mean, the leverage just helps out with the expenses. And what I've seen a lot of people do, I mean, think about it from, if we just use a simple math problem of, I'm going to put 100% into this property, or I'm going to put 25% into 4 properties, right? And so I'm spreading out my risk over the 4 properties, but I'm also bringing in lenders at that point. And if all 4 of those operate at their maximum potential, the leverage one is always going to produce a better after-tax result, the ROI, than the fully cash offer.
And sometimes taxes and being able to sleep at night and return on investment, but it's fully paid off, and now those are tough investment decisions. Scott and I aren't going to get into.
No.
We're not going to advise you on that, but just show you the tax implications.
Yeah, it's a very, very personal situation. So it's, sleeping at night is, if that's the number one goal here, then go in with an all cash offer, use insurance to back up your investment, and, whatever. But, you don't want to take a risk of foreclosure, or that your tenant not paying, or, I mean, there's a lot of reasons why you may do whatever it is you want to do. So don't think that, paying cash is a stupid move. It's not. It's just one, if you want to do that versus leverage, just understand what the differences are,
Great.
And make an informed decision.
And I think Sean's saying the same thing. Am I understanding correctly? Paying
exactly.
all cash will cost you dearly. Well, I don't know, dearly. It's an investment decision.
Yeah, absolutely.
Yeah. Okay. Scenario: a rental property without mortgage is held 25% in a Roth and 75% in an LLC. The Roth is the beneficiary to a trust. Well, it is a trust. A Roth is a trust. When the original adults who set up this finally pass away, tax-wise, what will happen to the Roth and the 25% inside the Roth? Doesn't it become an inherited IRA at that point?
Yeah, it would be inherited IRA. I mean, and then you've got beneficiaries of the Roth plan themselves, where you would have, it would just go according to the plan.
And then I don't understand inherited Roth or IRAs. I think they have got 5 years to liquidate Is that right?
Yeah, they do. They do. So there's specific, but you don't have a tax issue though with that. And I think that's what he's probably talking about here is that, when everybody finally passes away, the a Roth beneficiary is set up to some sort of a trust that flows in. I mean, this one, it gets a little complicated because we don't know the overall estate plan, but yeah, typically you would have a 5-year plan at that point.
Okay. Good. I'm glad you're on, Sharon. Thank you for asking the question.
Yep. We've got we got a lot of questions. We're not going to be able to get to all of these.
So we got to go a little faster. Okay. Can the town where a property is located demand to know how much income you're collecting on a commercial and residential building? I received a registered letter saying that I have so many days to let them know. I think they want to raise the RA tax.
Yeah, property taxes. Yeah, they probably do, but that's all of those types of things are all based on like local ordinance, whatever town ordinances. And so, if they have that right, maybe there are taxes on that income or whatever locally. So typically the local taxing authorities, man, they got a lot of authority because it pays the bills for everybody, the judges, the police, the fire. So the tax authorities can do a lot of things that other governmental agencies can't.
Scott, for a rental purchased in an IRA, full cash purchase, how is that reported in a tax return?
It's not reported. So you wouldn't have to worry about that because you'd have the IRA owning a particular piece of property, and the IRA wouldn't have to file a tax return unless there was leverage in it. So full cash purchase, there's no tax issues there, and there's no reporting on it.
And there is a little reporting that the custodian has to do, but it's nothing you have to worry about. Yeah, right.
Yeah. As far as any of that reporting goes, for sure. I mean, I always keep records of it, just because at some point I may decide that I want to get financing in that IRA. And so even though it's all cash now, let's say in 5 years, I want to pull 20K out and put it into another property. Well, at that point now I've got leverage and I want to know, have I made a profit in all the years? So I still keep a register, but nothing gets reported to the IRS.
Great. If I buy with cash and then flip a property to myself and refinance the same year, would I have the same result as scenario 2, since I refinance versus the result of number 1?
So you buy it with cash, flip the property to yourself. Okay, and refinance it the same year. I don't think it's going to make any difference which way you go there. You're going to get the same tax results either way.
Okay.
On that one, yeah, there would not be a difference there because I mean you still, anytime you have a self-dealing issue like this, if this was in an IRA, this would be a prohibited transaction and you couldn't do it.
Correct.
But since scenario 1 and 2 are in a taxable account, you could do it, but you're still going to recognize income on the flip if you're actually selling it, which would not be recommended because you've got a less than 1 year property, so you've got an ordinary income rate there. So yeah, I would not recommend doing much here other than buy the property and get it into your LLC or whatever you're going to use for asset protection.
Cool. All right. Is only mortgage interest tax deductible?
Yes. Your principal payments are not, but they kind of come out in the depreciation calculation. So mortgage interest, real estate taxes, and homeowners insurance is typically what comes out of any payments to your mortgage company.
Okay, good. Mimi, when down payment on investment property is coming from a HELOC, does the amount is it taxable for the year you bought the property? Down payment.
Well, you've got, when you're looking at a HELOC, you've got issues here. HELOC, by the way, is a home equity line of credit. And when you do HELOC loans on your primary residence, you can't just pay off other things. It has to go for the primary residence to be tax deductible. So, I think what you'd want to show here is that if you were using the money from the HELOC for a specific investment property, you'd have to deduct it on the investment property, even though the HELOC's on a different property. And then it's like I haven't seen an IRS ruling on this to see whether that is legit or not. But that would be my argument. So I don't know the answer to this question.
Yeah, I've seen it done, Scott, and whether it was done correctly or not. They did a HELOC loan on their house, but then the interest that they paid, they didn't write it off personally because it wasn't a personal deduction, but they did write it off as a business expense
Right.
because it was legitimate mortgage interest. But clearly you can't write it off on your own, on your personal.
Correct. Yeah, for sure. If you go out and buy a car with it, or you go to, go on vacation or something, that's not, you're out of luck on that one. It just seems to me that if somebody pulls out a loan from whatever source and they're using it on their rental property, or they're, say, using it for their small business, that interest is tax deductible. And so I think I like my argument. If I have to pick a side, I like the taxpayer there, rather than the IRS, because it just seems to me that you look at the source of the funds, where is the money going and what's it being used for, and whether it comes from a bank, to renovate a rental property, or whether it comes from a HELOC, I don't think it makes a difference.
Yeah, why don't you litigate that one for us, Scott?
Yeah.
And then we'll know for sure. All right.
Not a problem, Don.
I'll be the guinea pig. No, I'm not either. Never mind.
There you go.
Can a depreciation be captured in a retro manner, meaning hadn't done depreciation on property for 3 years? Can those prior years be claimed in a current year? Really nice try, Virginia.
Yes. Yeah. And that's a really choice question, I think, because people figure, oh, you know what? I blew it. I missed it. I'm out of luck. And based on Virginia's question here, I would say, hold it. You're not out of luck. You can always go back 3 years to amend your return. And what a lot of accountants will do here is they'll just make a book adjustment and they'll take it all at the end. But I mean, in the third year, let's say, but you could certainly go back and amend 2020 and amend 2021 and take whatever you can when you file 2022, next year sometime. But yes, you can go back and retroactively recapture this.
But only to 3 years. I
Yes.
can't go back for 10 years.
Correct.
Yeah. Okay. So pull out the value in a HELOC or of private funds and invest in multifamily.
Certainly, you certainly could, but that again is like very strong investment type decision. How much value, how much equity do you have in your home? What kind of value do you have? What's your interest rates? What kind of funding can you get privately? What's the return on the multifamily? So there's a lot of questions that would be more investment questions here than even tax related ones. But absolutely, I think the good part of this question, Don, is that we're looking at all these different ways to get money out and what's going to be the effect, both on cash flow and on taxes. Excellent question.
I love the fact that our students are thinking outside the box.
Yeah.
And saying, how can I, rather than, the normal pygmy thinking that we're used to, and well, I can't do that because,
Right.
Questions, how can I? Okay, so we have 5 minutes left. We're going to get to as many questions as we can, but we may not get to all your questions at the end. So here we go. Ruby, what if you had a primary home turned into a rental by default because it didn't sell timely in a due to relocation, but sold 5 years later at a very small gain? Would I have to claim the gain, but worked on the rental as a landlord more than other self-employed business? Hope that makes sense. It sort of does. Scott, does that make sense to you?
I like your answer. It sort of does. So well, that's the problem with taxes too, is that these questions sort of make sense and my answers sort of make sense, right? it's kind of what we're all working with here. But what it sounds to me like is we have a primary residence, and we didn't sell it, so we turned it into a rental 5 years later. So it was rented for 5 years, and then we sold it for a gain. And the question is, do I have to claim the gain? And the answer is yes, you do, because it wasn't a personal residence for 2 of the 5 years before the sale. Okay, so if you held it for a rental for a couple years, then you could eliminate the gain, especially in this case, because you said it's a small gain. But if it's a rental for 5 years, you've got to claim the gain, whatever it is. And so there, you want to make sure you get all of your expenses captured. And then that way you can reduce the gain and maybe even get it to zero.
Great. Thank you. All right, Rosemarie, explain the 2 ways to avoid recapture, depreciation recapture on the 1031 exchange and the trust.
Well, that's an entire webinar, but basically you can do a 1031 exchange to push off the capital gain to the future. And with estate planning, whether that's a charitable remainder trust today or whether it's just some sort of estate planning in the future, when you pass away, the depreciation doesn't have to be recaptured. And I think that's what I was trying to point out is you're going to pay the tax on the recapture either way. So you might as well depreciate it, actually claim the depreciation, get the upfront tax benefit, because there may be ways to avoid the recapture down in the future.
And we mentioned 3 ways to avoid the recapture. One was step up basis, which basically means you die and somebody inherits the property, it gets 1031 exchange kicks the can down the road, and the charitable remainder trust, it may or may not be a good option. It certainly wouldn't be for all your properties, but you're putting the asset into an irrevocable trust. You ain't getting it back. You're getting an income stream and a tax benefit, but as a result, the recapture depreciation, all taxes go away, but it's an irrevocable trust, and it's a really good tool, but not for everything in your portfolio. Arlene, is the 150 max to be able to take a loss on real estate for a single person also, or married filing jointly?
It's also for the married filing joint amount. That's right.
Okay.
That's right. Oh, you know something, Don, the next question is a good question here too. I'm just looking at that.
Yeah.
Can you claim expenses fixing the property as deductions, even though nobody is there? And that's a very good question, because remember I said, if nobody's living there, you can't deduct the rent that you're losing out on. But let's say you got to pay, I hired Don to go to my rental property, and I pay him $2,000 to, repair the bathroom. And some of that is, the toilet and sink, but some of that is to pay Don for his time. All 2,000 of that is fully deductible. So when you have a property that's vacant, you may have utilities, you still have insurance, you still have taxes. All of these are tax deductions, and you're going to get a loss, if you don't have any income coming in. So that's a really good question. Keep track of everything that you spend money on, because it's always deductible with your property.
Great. I have a friend who has rental properties, no loan in their IRAs. They are real estate pros. I don't get it. I'm stuck on how to use the depreciation when the property is in the IRA as a real estate pro. There is no depreciation inside of an IRA.
Without leverage.
Correct.
Yes. I think he's right here, or she or they. I don't know who he is on the question, but it seems like a big benefit loss. And I think you're absolutely right that the inability to deduct mortgage interest, to me, is like a huge factor to make it into the taxable account. So I think on that one slide I had where that 9% after tax, the biggest one we had was scenario 2. And that was where we had in a taxable account with a mortgage, because we're getting the full mortgage deduction, which means we can use the full loss then to offset other income, with the understanding that that 150,000 comes in. So that there is a limitation there if we're not a real estate pro. But you're right, it is a big benefit that could be lost. But real estate pros, again, with it, they're able to deduct the loss no matter what. So forget that $150,000 limitation on income, right? That they're making $150,000 a month, let's say. They can still deduct all their real estate losses. And that's why they really like the mortgage interest deduction, because it can offset income at potentially up at 37%. So it's a big deal for a real estate pro to be able to book real estate losses on their tax return, as opposed to having them stuck in an IRA, whether it's a Roth or a traditional, either way.
It's interesting that you say that, because I see real estate investors that are doing multi-million dollars of investing, and you think, oh, wow, they must be really smart. And some of them are doing some really dumb things. You don't know what you don't know. And just because somebody's a real estate pro or dealing with real estate in the millions doesn't mean they've figured it out.
No.
All right, Scott, we've reached the end of our time.
Yeah.
And I know you've got to go. I appreciate you being here. You want to answer just a couple more questions and not take any, or what's your time frame?
Let's do one final question and then we'll call it an evening.
All right. So I apologize if we didn't get to your question. I borrowed money to purchase a rental in cash. Is the interest deductible? And I borrowed it from my life insurance, my whole life insurance policy.
Okay, so the first one, I borrowed money to purchase a rental property in cash. Is the interest deductible? Yes, it is. But now I borrowed it from my insurance whole life. So now we have a related party transaction. That one I would have to look up and see, because the only thing I can see here is that obviously the benefit here is if you're borrowing it from your insurance whole life, then when it's paid back, it's not taxable to the life policy, but it would be deductible to the rental property here. And so we have a matching issue. I don't know the answer.
Okay.
Let's do one more. Let's do one more question, then. I don't want to end on something where I don't know.
We go ahead. You can read the question.
No, I was going to say for the person who sent me that question, and I can't see her name here or his name, but
Lalita.
Go ahead. If you could send me that question by email. So go to my website, scottestill.com, to send me an email saying I asked that question. I'll answer it, because I should know the answer to that question. Well, I think I should know the answer. And so therefore I'll look it up for you.
Or you can send it to me, Don P at protectwealth.com, and I'll forward it to Scott.
Either way, we'll get you an answer, because I think I should know that one.
Okay. How about our HOA payments tax deductible?
Yes, they are for rental properties. Otherwise, no.
Okay, there we go. And PMI is tax deductible. Okay.
Is PMI tax deductible? No. Well, I mean, you got the principal, right? Interest, taxes, whatever. Your principal is not tax deductible, just the interest.
Correct. Got it. All right. Thank you, everyone, for being with us. And Scott, thank you so much for your time.
Thank you, Don.
You put in a lot of time on this one. This one, it took Scott a little extra time to prepare the PowerPoint. Even though we've got an hour and a half, he's put a lot of time into the preparation for this. Scott, thank you so much. We appreciate your expertise. If we didn't get to all your questions, Scott will be on again November 14th through 16th at our 3-day Asset Protection Summit, and he'd be able I'd be happy to answer all your questions then. How's that, Scott?
I set
Oh,
myself
Scott.
up for that one, Don. So
Yeah,
yes,
you sure
bring them
did.
on. Bring them on. I'm good.
All right. Thanks everybody for being on. Have a great night. Good night.